Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 128 on August 21st, 2020. I'm your host, Eric. And in this week's show, we will cover the trades from last week on American Eagle Outfitters, the S&P Oil and Gas Exploration and Production ETF, and TripAdvisor. And then we discuss three new trades on NIO, Bank of America, and the S&P 500 ETF. Now, it's always great to hear from listeners. If you have any questions about any of the trades presented here on the show, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now this week, the markets finished relatively unchanged. The Dow Jones Industrial Average finished less than a point changed week over week, closing at 27,930 points. The S&P 500 index gained 24 points, closing the week at 3,397 points. And now it's time for the topic of the week. And the topic of the week this week is kind of a combination of things that I wanted to try out. So it may be a little cheesy, but actually it hopefully will condense things for you. And that's the ABCs of tradings. Yes, it's an acronym. I like to keep things simple. People tend to make better use of simple things. When things are complex, right? Complexity tends to lead to delay. You might say to yourself, oh, I'll get to that later. I'll have time to understand that better. I'm going to have to take some time to study. No. Let's keep it simple, and I want to give you guys some usable ideas or strategies for your trading to improve. So here we go. A is for analysis. I always start with analysis. And with options, we care about two different things. We have to care about the actual option prices, and we also have to take a look at the underlying stock price. Now, which one you choose to begin with is less relevant. Your method is important, but this is a situation where some form of analysis is better than none. Now, I tend to use technical analysis to get a sense of where the stock has been and where it might be headed. I've always liked using technical analysis indicators like Fibonacci analysis and the MACD analysis. I've gotten into a little bit more of the Ichimoku cloud. I'll do some Bollinger Bands, some Keltner bands as well. There are a number of indicators out there that can be very useful for your technical analysis. Really, you just have to find something that works for you. It could be as simple as moving averages and doing some sort of a crossover thing. Either way, some analysis is going to be better than none. And certainly, if you have an idea of the specifics for the option trades that you're looking for, analyzing the option prices will be paramount to your success. So that's it, okay? A is for analysis. B is for blast off, mostly because it sounds better and more exciting than begin. Either way, you must place the trade. You got to pull the trigger or hit the buy or sell button. You will never make any money without placing the trade. Now, you might say, well, I won't lose money either, but I'd argue against that. See, by not placing the trade, you're actually preventing yourself from learning a lesson that you're likely going to have to learn at some point anyway to be successful. So you might as well go ahead and pull the trigger and start your learning process today so you're one step closer to being a successful trader. So that's it. B is for blast off. And finally, C is for close. Specifically, it's learning how to close the trade. Now, I don't mean just, buying options back that you sold or selling options that you bought. Maybe you've heard that you have to close your losers early and let your winners run. Well, that's a little easier than it's easier said than done oftentimes in stock trading, and a number of day traders and long-term stock traders will tell you that. And the reason is because your emotion can get in the way. But I find this to be a little easier in spread trading because the numbers, we know all of the numbers right from the start of the trade. We know our maximum gain and our maximum loss. Now, still, you have to make tough decisions sometimes on whether to close a trade, which might be taking a loss, or to let it ride. You also have to know when you've likely made the most profit you're going to make in that spread, and it might be worth closing before expiration. So there's still some nuances to the close, but at the end of the day, if you're gonna make money in the market, you have to at some point close that trade, right? If your money is still in the market, you haven't made a profit. Now, I still struggle to wait until I close the trade to count my profits every now and then. Sometimes you look at your account and just get excited on where it is, and oh man, at expiration it's going to be here or there because I'm going to fully capture the value of this spread. And then, the inevitable happens and the price goes the other way, and you end up kicking yourself for not having closed it or taken a profit when you could have so easily. So just remember, learning when to close is both art and skill, and it just takes practice. So there are a lot of things about trading that just takes a lot more trading to get good at and to learn. And that's just part of it. So this all takes practice. So start practicing the ABCs immediately: analysis, blast off, and close. So that's it for the topic of the week. Let's go ahead and get into the trade review this week. And, for the market to have overall been relatively unchanged, we definitely had some movement in some of our stocks this week. So we'll start off with the covered call. We looked at American Eagle Outfitters, symbol A as in Alpha, E as in Echo, O as in Oscar. The stock at the time was trading for $11.68 per share. I looked at buying that stock and selling the September 12 call at 95 cents, hoping for a return of 10.87% in 5 weeks. Well, American Eagle stock lost 94 cents this week, closing at $10.74. The call option that we sold lost 45 cents, which leaves us with a net loss of 49 cents this week. And remember, when you sell an option and it loses value, that actually is profit for you. The reason this is not a profitable trade, though, is because our stock lost more than our option lost this week. So now, as I would usually do, given that we have 4 more weeks until expiration, I would roll the strike lower on the call option. That means buying back the September 12 call and locking in that 45 cents profit, then selling the September 11 call at 70 cents. That offsets your net loss on the week with the stock and the trade, and it might give you a little more room to keep this trade from ending in a loss. Of course, this type of trade is ultimately driven by the stock price. So if you think the stock will continue heading lower, you might consider just closing the trade. So selling the September 11 call would only give you another 21 cents of cushion to sustain a further loss in the stock. So definitely, before you ever add on to a covered call trade and to try and keep it or make it a winner, definitely analyze that stock a little more, like I mentioned in the topic of the week, and decide for yourself if you think the stock's going to pull back ahead or go lower. We need the stock to go higher in order for us to make a profit on this trade. Next up, we have our credit spread. We looked at the S&P Oil and Gas Exploration and Production ETF, symbol X as in X-ray, O as in Oscar, P as in Papa. At the time, the stock was trading for $56.16 per share, and I sold the September 56.55 put at 35 cents. No, it's a put spread at 35 cents, which could give us a maximum possible loss of 65 cents per spread. Well, XOP shares fell $4.42 this week, and that out of the money put spread we sold is now deep in the money. Now, if we were to buy the spread in, you would lock in a loss of 50 cents. And this spread, of course, will expire in 4 weeks, being valued at $1. So if you left this trade on and it actually went lower, the most additional money you could lose is another 15 cents. Now, with 4 weeks left in this stock, and in this option, 4 weeks is a long time from now. And I typically like to sell a call spread against a short put spread position like this. I turn it into an iron condor. The strikes would have to be higher than the put spread that we sold. That might mean selling the September 57.58 call spread. If we did that, we can collect 12 cents for selling the spread, which knocks our loss down to 38 cents. Of course, it creates a really tight profit range in the price. So in general, that makes it not worthwhile for me. I'm not getting paid enough for selling that call option to take on the risk of ending in loss anyway. So I'd rather wait a few days on making a decision on what I'm going to do with this trade and see if the stock doesn't find some support and pull higher again. Now, given that we can only lose 15 more cents, we're near our maximum loss. So for me personally, I would lean more towards letting time work for me, which means leaving this trade on and seeing if the stock is going to pull higher and pull this trade back into profit. And then my final trade on last week was on TripAdvisor, symbol T as in Tango, R as in Romeo, I as in India, P as in Papa. At the time, the stock was trading for $22.29 per share. We bought the September 21-22 call spread for 68 cents, which can give us a maximum gain of 32 cents or a 47% return. Now, TripAdvisor stock fell 29 cents this week, closing at $29 per share. The in-the-money call spread we purchased is still technically in the money. In fact, the spread itself lost 23 cents of value if you were to just close the trade by hitting the bid on the spread. However, we own the September 21 call. That call right now has an intrinsic value of $1. So there's absolutely no reason to make any adjustments on this trade yet unless you believe the stock will head lower. Now, not to sound like a broken record, because I've said this a couple of times already, but with 4 weeks of price action still ahead of us, I would hold on to this one and see how it plays out. Definitely be vigilant against all of these. You have to know your numbers and abide by them. But remember, in these spread trades, you know the maximum gain and the maximum loss right from the start. So you can plan, ideally, you can trade rationally rather than allowing emotion to truly take over in this situation. So let's take a look at the 3 new trades for this upcoming week. We're going to start off with a covered call on NIO Inc. It's an ADR. That's N as in November, I as in India, O as in Oscar. The stock ended the week at $14.12 per share. I'm looking at buying that stock and selling the September 15 call at $1.01, which can give us a maximum return of 13.39% in 4 weeks. Now you enter this trade by buying NIO stock for $14.12 per share and selling the September 15 call at $1.01. This trade makes the most money if stock prices finish above $15 per share, and the break-even price on this trade is $13.11 per share. Now in real terms, the stock purchase would require $1,412, and you would collect $101 for selling the option. Now, our second trade for this upcoming week is a credit spread on Bank of America, symbol B as in Bravo, A as in Alpha, C as in Charlie. The stock ended the week at $24.98 per share. I'm looking at selling the September 25-26 call spread at 34 cents, which can give us a maximum possible loss of 66 cents per spread. Now you enter this trade by selling the September 25 call at 81 cents and concurrently buying the September 26 call for 47 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices finish below $25 per share. The break-even price on this trade is $25.34 per share, and in real terms, you will receive $34 per spread that you sell and have $66 at risk. And I've mentioned to you guys before, I'm a big fan of trading Bank of America options. They always seem to be priced well. There's a lot of liquidity there. But just know that we are selling in this trade. It's selling the at-the-money call spread. Literally, we're 2 cents away, 2 cents out of the money right now. So this is the at-the-money call spread that we're selling. And by selling that call spread, you really are saying that you expect this stock to go lower, which might be, highly tied to the overall economy of the U.S. So just know, oftentimes these companies have a beta, and I haven't talked about that concept, but they have a relationship with the overall market index. Bank of America, bank stocks in general, have a high beta to the overall health of the U.S. economy. So selling a call spread means that I'm expecting this stock to go lower, right? Go lower because I'm selling the call spread. So I'm expecting stock price to go lower over the next several weeks. I could be wrong. We'll find out in a week. Okay, so let's get into our final trade. Looking at a debit spread. And this is another one that I like to trade often. I'm big on the ETFs because I traded those back on the CBOE. It's been a decade and a half ago since I was on the options exchange, but I still trade those in my personal account. So looking at the S&P 500 ETF, symbol SPY, S as in Sierra, P as in Papa, Y as in Yankee. The stock ended the week at $339.48 per share. And I'm looking at buying the September 339 call spread for 68 cents, which can give us a maximum gain of 32 cents or a 47% return in 4 weeks. Now you enter this trade by buying the September 338 call for $6.99 and concurrently selling the September 339 call at $6.31. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices finish higher than $399 per share. The break-even price on this trade is $338.68. And in real terms, you'll pay $68 to enter this spread, and your maximum gain is $32 per spread. So that's it for the trades this week. Thank you guys so much for listening. Thank you guys also for emailing me. I'll be getting back to those of you who I haven't had a chance to respond to, ideally this weekend. So as I tell you all before, I do actually reply to my own emails. So sometimes it takes me a little bit of time because several of you email me. Thank you so much for listening. Please continue to share the show with your friends because we're growing in listeners. And that just makes me happy because I really do this because I want to help people and walk you through the process of learning to trade options. Because honestly, so many people actually own stock in their portfolio these days because of a 401k or an IRA. All of these retirement plans that we have, retirement accounts. But people aren't learning option trading the way they should. And to me, if you're going to know how to trade stock, you should also know how to trade options. I'm obviously biased, but hopefully you guys are too since you listen to the show. So thanks a lot. Have a wonderful weekend. And as usual, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.